Hello, my friends. Today is January 11th, and this is Markets Weekly. So we had a bout of volatility in the market today, some notable up days and down days in the equity market. But I think the real focus of the past week was the bond market, where we basically had a global bond market sell-off, and that will be the focus of our discussion today. But before we continue, I'd like to note that I've added a new section on my website called Market View. So a lot of people ask me what my market views are, so I decided to share that in the form of a Market View portfolio available to my subscribers. Now, this is not intended to be investment advice, nor is it intended to be a trading portfolio, but it's just basically meant to be a portfolio that represents how I view the market, and I will update it gradually. And as you can see, last week I closed a put position in the S&P 500, and my core view is bullish rates, so bullish bonds, bearish the dollar, and bullish gold, and no equity exposure. Okay, so today what I'm going to talk about is two things. One, of course, is the global bond market rout. And secondly, the good jobs data we got in the US, and these two are related. Okay, starting with the bond market. So looking at the global bond market, we'll see that they really had a really big sell-off the past week. We focus in the US on treasuries, but it was really bad in the UK as well. And even Japan saw a rise in yields. An exception, of course, is China, where yields continue to decline, but they have capital controls over there, so they're somewhat disconnected from the rest of the world. And as we all know, they're suffering some idiosyncratic problems. So what is driving this rise in bond yields? Well, I think the first thing to realize when we approach the market is the richness of the market. And what I mean is that the market has many, many different market participants. Each have different views of the world, each have different constraints. For example, an active participant in the market is the Fed or other central banks, and those guys are not even trying to make money. So this is where I think that the textbook explanations are very inadequate. Take the equity market, for example. Now, if you read a textbook, they'll tell you that equity prices are the discounted cash flow of expected future earnings. So you can try to forecast earnings, come up with a discount rate, and voila, you get some kind of sense of valuation. Now, that all sounds totally reasonable, but when you look at the public markets, you'll realize that that's just not how the world works. Look at AMC or GME, for example. Those stocks, sometimes they surge just simply because Roaring Kitty wants to post something, has nothing to do with their earnings. Or more importantly, we actually know who some of the big buyers in equity markets are. Mike Green has done a lot of good work on passive investment, and he shows that a lot of the buying in the equity market is just through 401ks or target date funds, where an employee receives a biweekly paycheck. Some of that paycheck goes into the market, and that's just money that goes into the market, irrespective of what expectations for earnings are. So it's because of this big disconnect between the market and the textbooks that I created this free course called Market Participants to help others understand some different perspectives on what drives price action. This is, of course, part of my Markets Complete series that I created to help people understand the market, because in my experience, what is taught in schools is just not very useful. So moving back to the bond market, what are some common stories to explain the rise in yields? Now, a very common story that I see on social media is because the market is afraid of inflation. Now, maybe Trump is coming, and maybe President Trump will spend a lot of money or something like that. And so the market is freaking out about potentially out of control inflation, Weimar Republic stuff. And so the bond market is freaking out. Now, that's possible. But then if you look at another traded asset, TIPS, you can see that TIPS implied inflation has been pretty steady for the past few years, ranging between 2 and 2.5%. We had a bit of a recession scare a few months ago, but as that scare receded, we went right back up to where the ranges are. So based on this market-based traded view of inflation expectations, there just doesn't seem to be a lot of fear of inflation in the market. Now, to be clear, this is not a perfect measure, but it is a measure, and I like it because it is tradable. So if you have a view that's different from it, you can take a position. other surveys of inflation expectations, like consumer surveys, show some fluctuation. It doesn't seem like it's getting out of control, but I would note that the people who participate in these consumer inflation expectation surveys are probably not going to be trading in the market. So I don't think that they have a big impact of it. Now, there's some interesting survey evidence that suggests that there is a strong partisan tilt to inflation expectations, whereas if you supported the president, you think inflation is going to be okay. If you did not, you're kind of freaking out. So, but again, the stuff is on the consumer level, and I don't really think it flows through into the bond market, which most people are not trading. Another possibility for higher yields is that the market is pricing in fewer Fed cuts. Now, this, in my view, is what is driving the rise in the 10-year yield. Now, the good thing is that there's a very, very clear way to measure the market's expectation of Fed policy, and that is SOFR futures. Now, SOFR futures, very, very deep and liquid markets, very actively traded, so you can be pretty confident that this is a good representation of what the market is thinking. Now, in this chart here, I show the expected path of Fed policy as of Friday and a month ago. And you can see that there's been an absolute sea change in how the market is perceiving the path of policy. So a month ago, the market was thinking, maybe the Fed will cut as much as to 3.8% and then gradually start hiking again. As of last Friday, the market is thinking that, maybe the terminal Fed funds rate is somewhat above 4%, and then the Fed will start hiking again in 2026. And that just huge change in policy expectations is, in my view, what's pushing the 10-year yield higher. Not anything to do with inflation, just that the Fed, again, is not going to cut as much. Now, why is the Fed not going to cut as much? One is that the economy is stronger than they thought. Again, they were afraid of recession not too long ago. They're not afraid of it now. Inflation has been stickier than they expect, and so they're cutting less. But again, that's the Fed, how the Fed views the world, not how the market views the world. If you look at TIPS implied break-evens, they just haven't been concerned about inflation for the past few years. So from my perspective, this is just a change in policy expectations. Oh, one other thing, of course, is the Fed came out and openly told you that they don't want to cut as much, and so the market is pricing that. So other potential stories for what is driving the 10-year yield higher is term premium. What is term premium? Term premium is basically the extra compensation investors require in order to hold 10-year treasuries above the expected path of Fed policy. And this is a totally reasonable story as well. Obviously, we have a very large fiscal deficit, so maybe people want a higher term premium, need more risk, need more compensation to hold that risk. Now, whereas the concept of term premium makes total sense, it's a very difficult thing to measure. Now, there are actually studies that do meta-analysis on term premium where they take out a whole bunch of term premium models, compare their outputs. And what they find is that if you have 10 term premium models, you end up with 10 very different term premium estimates. Now, if the term premium estimate is so model dependent, it's hard to see it being very useful. A very popular measure of term premium is the Adrian-Crump model. That's also what people in the Fed use a lot. And you can just look at this graph of the ACM term premium over a few decades to know immediately that it's not useful. Why do you know it's not useful? Because it's not mean reverting. So if there were many people in the market who made investment decisions according to the ACM model, you'd expect term premium to be mean reverting. What that means is that when term premium is very high, these guys would jump in and buy the 10-year yield so as to make the term premium mean revert to some kind of historical mean. And when the term premium is very low or even negative, you'd expect these guys to be selling the 10-year treasuries until the term premium reverts to some kind of mean where you have more buyers come in. But obviously, this is not mean reverting. It just kind of trends up and down. So I don't think it's useful. A more useful measure of term premium is swap spreads. Now, swaps are the tradable market's expectation of what a Fed policy would be over a period of years. And what you see is that the spread between treasuries and the swaps has been widening over the past several months. So that does suggest some degree of term premium, but overall it's quite small. And part of it also has to do with regulatory constraints as well. So taking a step back, looking at the totality of all this evidence, to me, it suggests that by far the biggest driver of the rise in 10-year yields is the path of Fed policy. And you can make an argument that there has been somewhat higher term premium, somewhat higher inflation expectations, but those are just not that important. A related interesting thing is that, so because the bond market is global, obviously if you have, say, treasuries in the US dollars at 4.75%, why would we be buying something yielding less in another currency? So what's been happening in the treasury market has been pulling up global bond yields, whereas you can see there's a very tight relationship with UK gilts and treasury bonds, for example. As treasury yields have gone up, UK gilt yields have gone up as well. So it seems like the sell-off in the treasury market is really pulling up global yields, which is really bad news for a lot of them because their economies are just not as strong as the US economy at the moment. So whereas the Fed is setting policy in the US, looking at stronger than expected US growth, stickier US inflation, and that is pushing up US yields, the US yields are in turn dragging up global yields, and that's going to put a lot of downward pressure on foreign economies. So that's something to pay attention to going forward. There are other narratives that focusing on the UK, talking about things like a fiscal crisis and so forth. Maybe there's a little bit of it, but I think the clear explanation is just that treasuries are rising and causing a global bond sell-off. Okay, and the next thing I want to talk about is related, and that is the stronger than expected strength in the US labor market. So on Friday, we got the all-important non-farms payrolls report, and its headline job creation number just kind of blew expectations out of the water. We created 250,000 jobs last month, much higher than expectations. Now, as we usually do, we have to also look into the details, and the details were pretty good as well. Now, first off, looking at average hourly earnings ticked down a bit. So you could think of that as some degree of weakness, but when in the context of inflation, that's good news because lower wage growth suggests downward pressure on services-related inflation. But the other really big news was the unemployment rate, which ticked down to 4.1%. Now, that is a number that the Fed is focusing on a lot, right? The Fed has become more focused on the unemployment rate, its other mandate. And with that ticking down to 4.1%, the market is thinking that the Fed is probably not going to have to cut as much. And you see that immediately in the big bond sell-off right after the print. Now, looking at the labor force participation, that was pretty steady as well. Now, in addition to the non-farms payrolls report, last week we also had a couple other employment-related data. We have the JOLTS report that had a surprisingly a higher than expected amount of job openings. But when you look at it as job openings to workers looking for jobs, you notice that it seems to be stabilizing at a level that's a little bit below than what when it was pre-pandemic, but stabilizing nonetheless. Looking at the ISM surveys, the employment component in the ISM services is still above 50. Again, only a little bit above 50, but that's consistent with increased job growth. That is to say that services industries continue to expand headcount. So overall, the labor market seems to be doing okay. Now, if you zoom out a little bit and look at labor market data over the past year, there's this good graph from Bloomberg suggesting that, it seems like job growth has stabilized and may potentially have turned a corner. Again, it's still too early to know, but right now, so far, it seems that the labor market is okay, and that means that the Fed doesn't have to worry about its employment mandate. Okay, so that's all I prepared for today. Thanks so much for tuning in. And I'll be back next week for our weekly market update. See y'all soon.